What's better than one way to earn income trading options? Simple, two ways to do it. That's what the wheel strategy is all about, and it's one of the go-tos for options traders craving income. So let's find out how to trade it and how you can help boost your chances of success. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise. We hope you've enjoyed Options Education Month at TD Direct Investing. June is almost over, but there's still time to learn about options, so head over to td.com/OEM for a list of upcoming events and a ton of on-demand content to check out as well. Now, on to today's show and an important programming note. We were supposed to chat with options trader Marcus Heidecker from Rockwell Trading. Unfortunately, an emergency came up and Marcus sadly was not able to make it to today. I know he was really beaten up about it, and of course we'd love to have had him, but we're in luck. We got our own Bryan Rogers stepping in to tell us all about the wheel instead. We're going to explore how this trade works and some of the best practices to consider to help you boost your chances of earning consistent income with it. Plus, we're going to take your questions on options trading in our live Q&A session later in the show, so stay tuned for that. Let's get rolling here. Joining us is Bryan Rogers, Senior Client Education Instructor at TD Direct Investing. He's been teaching investors all about option strategies throughout OEM here. Bryan, thanks for joining us in a pinch. Really appreciate you joining us here.
No, my pleasure, Rob. I wish I had hair that was as good as Marcus, but that we'll have to do with this.
That makes two of us, and I'm getting closer to you than closer to Marcus these days, I got to say. But in any case, Bryan, you've been a fixture during OEM here, showing investors the ropes on options trading here. How's it been going so far? How's it been treating you?
Oh, it's been fantastic. Our team has really stepped up. It's been amazing. I've seen all kinds of great comments from clients that have come in or attendees that have come in and wow, I wish I had this a long time ago when I first started trading, because they're learning all kinds of stuff about options from, really beginner stuff on what is a call and what is a put, all the way up to, I know you love those crazy names of strategies, Rob, like wheel is another one we're going to talk about today, about the iron condor. We have a new class about the iron butterfly this year. And my colleagues here and Jason have been doing some phenomenal sessions where they tag team and they look at, the life of a bullish trade, for example. Like, how would you go that from, start to finish on, entering a trade? And what are some considerations? And they're actually doing it on our active trader platform to show the trade. And then each week you can see how that progresses. And Jason's done pretty well. I think the market's been a bit bullish. So he's done well on some of his trades that he's put in. But it's really cool to see that, that go from step to step, that you get to see that on a live basis every week.
Yeah, and I think that really helps people learn and visualize how these things all work. I got to say, Iron Butterfly, that is a sweet hard rock / metal band name. So we'll have to explore that trade in a different episode too. I love that one. But we're talking wheel today. And Bryan, of course, you're an options trader yourself. You're familiar with this strategy. Why do you think it's become so popular amongst options traders looking for income?
Well, yeah, that's a good question to ask, because, it's one of those things. We were thinking about that the other day, myself and some other colleagues, we were discussing that. We've often done ourselves a lot of covered calls, but we see, a lot of clients or people that are in our classes, that are getting into selling puts. It's a strategy. When you're brand new, I think it's something that, is a little bit more, has a bit more risk to it. But the key thing I think that's happening in the market is, from 2008 until 2019, it was almost a 10-year run there, or 10 or 11-year run. The markets were trending bullish almost all the time. So when you sell a put, when you're selling put, you're collecting income, and it's somewhat of a bullish strategy. You're not like extremely bullish, you're neutral to bullish. If you're somebody that's seeing, hey, I can collect income and I can sell that put, and I can potentially, it's going to force me to buy that stock. A lot of people were noticing that I can collect money on selling these puts. But then as the market started to change a little bit when it went into 2020, and then, even in 2020, 23, they started to get a little bit more neutral, and sometimes even on the bearish side. So people were getting assigned where they're buying the stock, and now they're saying, well, hey, I can sell calls and I can collect income that way. So it's one of those things that I think came out of necessity, that the market just drove it. But it's definitely a popular strategy for those that are getting into that little more intermediate to advanced kind of stuff.
Yeah, certainly the markets have had a different flavor as of late, as I'm sure many investors can attest, of course. The wheel is one of these strategies then that, like options, gives you options, right? You can explore different things like the wheel here. Would you say it's a relatively beginner-friendly strategy, though, or do you need to be a little bit more sophisticated to really use it to good effect?
Well, I think the structure of it, if someone were to learn it today, which we are going to learn it today, is, you can see the structure where if you know how a put works, if you're buying a put, you have that right to sell a stock. And if you're selling to open a put, you have that obligation to buy the stock. That's usually the starting point of the wheel strategy. So if you look at all the little pieces, it's pretty, what I would say, it's not super complex. It's a little bit more complex than learning, like, say, a call or a put on its own in general, because you're putting more pieces together, but it's done individually, right? Like not individually, but initially you're selling a put, and we'll get into all the details, but then you're going into covered calls, which I think are fairly basic. But then what happens is just being able to manage that, because you do have to have typically it's traded on US dollar stocks and in a margin account. There are some margin implications you would have to know about. You may have to have the cash, in place for the put. So there's a number of variables that I think make it a little bit more complex, and then even just managing those trades on the risk that can be significant on the downside sometimes. So that's where I think it gets a little bit more intermediate to advanced.
Okay, so good to set some expectations there for our viewers here. Speaking of some of the particularities of this trade, what sort of like options trading permissions would you need to have in your account to be able to trade the wheel?
Yeah, within TD Direct Investing, it could vary with other brokers, but that we have a level. We have like a level 1, 2, 3, and 4. If you're going down to level 1, that's the basic. What I was talking about, if you're going to buy a call and buy a put, and the reason that's a lower level is that the risk is defined, that you're going to spend maybe a couple $100s on a call. The gain is maximum, like it's unlimited, so you can potentially gain an unlimited amount. So something that's not very risky. So we have a lower level of approval. When we get up to this, because we're now implementing where we're doing a naked put, potentially, you could consider it as cash covered in a way. We'll explain that a little bit later on. But, when you're getting into these higher risk trades, you have to have a level 4 trading approval. So it's something you do have to get approved for. It may not always happen for everyone, just because you have to have a certain level of, trading knowledge and experience and a certain type of account. So that's something you would have to apply for, and it has to only be available in a margin account. So, where it's a taxable account that you're doing this, but level 4 so the highest level of approval would be required for the wheel strategy.
Okay, so some good high-level stuff to be aware of here for viewers here. Let's get down to the heart of our conversation there, though, and that's how to trade this wheel strategy to, generate income and hopefully generate it consistently. For those in our audience who want to get in on the conversation, you can make sure to submit your questions to us here. If you're watching on Webbroker, use the chat box. You can get your questions over to us. If you're watching on our live broadcast platform here, you can use the question and comments box. And if you're watching on our YouTube live stream, you just click on the link in the description. It'll hop you over to the broadcast platform, and that's where you can ask your questions. All right, Bryan, without further ado, let's get down to business here and get things rolling, pun fully intended here. Can you explain how the wheel strategy works at a high level for us?
Well, yeah, it's one of those things, like all of these option strategies. We talked about the iron condor, and we talked about the iron butterfly earlier, Rob. Like, they always usually relate to a profit and loss graphic. The wheel's a little bit slightly different, but the reason it's called a wheel is the fact that you're selling income. So I mentioned those puts. A lot of times it starts with a put. You're selling a put for income, which is always what you're doing if you are selling a put. But the obligation that comes with selling a put is that you're potentially going to be forced to buy the stock. You often will sell a put a little bit lower than almost always going to be lower than the current market price, so that you can hopefully keep that premium. But if the stock does dip down a bit, you're going to be buying a stock that you're probably hopefully going to be okay owning anyway. And then what happens is, now if you do get assigned, you got to keep that premium initially. Let's say if you collected a couple $100 or $2 per share, which is the way options work on the contract, you could collect that money. You could potentially get assigned if the stock drops a little bit. You're going to buy this stock, and hopefully maybe you can own it for a little short period of time. But then right off the bat, you're going to sell covered calls. If it seems to make sense and you're going to get a decent premium, you're going to sell a covered call, which that now gives you an obligation to potentially be forced to sell the shares that you just purchased. So if you see where I'm going with that, Rob, like, say how it spins around like a wheel, in the fact that you're selling those puts, and then if you do get assigned, that's an action that's going to take you into selling calls. And then if that happens where you sell a call and you get assigned on the call, you're going to sell your shares. And then you're going to, next thing you know, you have some more money in your account and you're going to sell some puts again. You could do it on the same stock, but you can do it on some other ones, but it goes continuously, goes around and around in like a cycle, like a wheel.
Yeah, so and everywhere on this wheel, there's an opportunity to earn some income here, depending on how you trade here. So interesting visual, interesting concept. I always find it's really best to walk through some kind of example, basically, of how these things can work here. So can you give us, like, the good, the bad, and the ugly here? Like, how does a trade be profitable, not so profitable, and then, like, worst case scenario kind of thing when we're trading the wheel?
Yeah. No, that's a good question. And it's a good way to think of it, Rob. I like that because, when I learned it, and I even still think of it this way to this day, is there's all those little pieces, right? Remember I mentioned you can think of things individually. If I sell a put, and those in the audience that are familiar with it, there's somebody that's brand new, this may be hard to grasp, but hopefully we can simplify it for you. Remember, I mentioned earlier, when I buy a put, I have the right to sell a stock at a certain price. So we're looking at the opposite now. We're looking at, I want to sell to open a put. I'm collecting income. Okay, so that's one piece that's there. So if I'm selling to open and, I'm collecting income, then, I'm hoping to keep that. So this is it's a mildly bullish sentiment because puts, remember, I'm obligated to buy the stock. So one other piece too, and one other factor to consider is, you may be okay buying that stock anyway. I know somebody that used to be on BNN Money Talk quite a while, Phil Davis, used to talk about this all the time. He'd say, that's all right. If I get to buy this stock and I'm buying it at a bit of a discount because I'm collecting income, I'm okay with that. Okay, so that's kind of a good scenario where, if you end up collecting the income and not necessarily buying the stock, that's good because you can do that over and over and over again. You're never establishing the wheel. That's only a little piece of it that you can do over and over again. But then if you do get assigned, you're going to buy a stock that you might be potentially okay, or you should be potentially, I shouldn't say even potentially, you should be okay with holding for a little bit of a longer time period. And now you have that ability to sell calls, and you're going to sell calls a little bit higher than what you bought the actual stock at when you sold those puts. So you can see how that can be pretty beneficial. You could just one way or another sell premium, like a collect premium, and that goes into your account regardless. Or you could end up with a situation where if you bought the stock by getting assigned on the put, then you could sell calls for months and months and months and never get assigned, as an example. So that's a really good scenario. A bad scenario, I don't know if we have any visuals for this or not, but a bad scenario would be if you did sell that put, and this is where I was talking about earlier, is that's why you want to make sure you have that higher, or we make sure that you have that higher approval level. If you sell a put, for example, let's say if you sold a put on a stock that was trading at $80 in the market and you sold a put at around $70, like a little bit below, and the stock for a little while stuck around 80, maybe 79, but then it dipped down and it dropped down to like 50. If there was some kind of black swan event or something happened that was really dropped the stock on the downside, now you're in a situation where you're going to be forced to buy the stock at $70 that's trading at $50. And then what happens? What happens if it keeps dropping? If it's dropping even further, you're in a situation you might be hoping, I hope the stock comes back up, but if it does continue to drop, you're going to have a potentially significant loss on that stock. There are ways that, I may touch on later on, there are ways that hopefully you can, possibly get out of that to some extent, but if you have a major drop, there's that downside risk is there, and that would be, in my mind, is the worst case scenario.
Mm-hmm. And we were talking about levels of permissions here earlier. How much money do you think someone would reasonably want to have if they want to trade the wheel, but also have enough money on hand to manage their risk if things go awry, like you were saying?
Yeah, that's a really important consideration, Rob, because of the fact that, if you're going to do most stocks that are, fairly active on options trading, ones that have a high amount of volume and open interest, a lot of times you're looking at stocks that are, 50 to 100 to maybe even higher. And that's one of those things. You remember, once again, you're looking at stocks you would potentially want to own if you were assigned. That's kind of one of the criteria we have with the wheel strategy. You don't have to have that, but I think it's a really important one because, if you're going to get in a situation where you're owning that stock, you want to hope that it's going to recover if it does go down past that put strike you choose and you get assigned, that you're going to hope it does recover. So, you're looking at fairly expensive stocks in many cases. So I would say at a minimum, like short answer, you do have to have around $10,000 regardless in your account to have the option approval level 4. If you're going to do any short options like naked options, naked puts or naked calls, which the wheel strategy does have the put element. So you want to have that, but I would say at least probably 25,000 in my opinion. Because if you're doing a stock that's trading, around 80 to $100, that's about $10,000. And if you have the cash, you don't have to necessarily have all the cash to do the strategy, because you can do this on margin, which is a little bit more of a fraction of the amount you would need to do the strategy to sell the put. But if you do get assigned on the put, like I just mentioned, if it's a $100 stock, you're going to want to make sure, hopefully, have that $10,000 to buy the stock, and you're not buying it on margin and getting charged interest over time. That could, I think, throw a wrench in your strategy, where you're collecting more income on the calls, but you're also on the other side, you're paying interest every month.
Yeah, certainly you want to give yourself enough dry powder to work with, just in case you need some backup if things get a little hairy there on the trade. But anyway, thanks for laying out the basics of the wheel strategy here for us here. Just a quick note to our viewers here. If you're hearing all this and you're like, hey, this sounds really interesting, and you're itching to start trading options here, well, TD Direct Investing has a couple of offers for you to check out here. The first offer is that new and existing clients are eligible for a 1% cash back when they transfer $10,000 or more into an eligible direct investing account. Just open a new account with the promo code CASHBACK2025 and fund it within 30 days. You can also enroll an existing account if you use a registration form that we have there. And there's also a second offer. You can get free access to streaming market data on the TD Active Trader platform until the end of the year. Just open an account and complete the onboarding process before November 30th of this year. You can scan the QR code on screen for more details and for a full list of terms and conditions. Fantastic offers, still open even when OEM closes, so make sure to keep them top of mind here. Okay, Brian, we've heard how the wheel strategy works here on a high level here. Let's talk through how to set up this trade. So what type of stocks might generally make sense to trade the wheel with if a trader wanted to kind of help limit their potential downside and the risks that they're taking with it? I know we hear a lot about the high-flying tech stocks, and you had mentioned those a little bit earlier, but what kind of stocks in general do you think make sense, particularly for someone just starting out with the strategy?
Yeah, well, there's a lot of nuances you can get into on this. Like, I think some look at, technical analysis and all kinds of different things. I don't look at that myself. I'm more looking the foundation. Remember, I mentioned the first part of the wheel, the thing that gets the, pun intended, gets the wheel rolling, is selling that put, right? So you want to be in a situation, not only market-wise, but, stock-wise, into something that, hey, I'd be okay owning this stock, if I had to for a little bit of a longer time period, right? So you're looking for stocks that have that are consistently profitable. You can look at, maybe if you're looking at things on the S&P 500, or whatever index you might be looking at that you think is reputable in your mind. And then from there, you're looking at, do they pay a dividend potentially? Like, do they consistently pay dividends? Is it something that, remember I mentioned that bullish versus bearish? Am I extremely bullish on the stock? Like you said, high-flying tech stocks, Rob. I'd probably not want to necessarily do that. There's other strategies I could use if it's a stock that, is going to consistently have amazing returns and go up and up and up on a super upward trend. I may want to avoid a stock like that. But a stock that's, merely mildly bullish, I'm okay. I notice this is kind of like slow and steady wins the race. It's always, on a somewhat upward trajectory. It might be up and down a tiny little bit, but it's trending upward. And, that idea of that you're sort of neutral in a way too, neutral to bullish, because if it does drop, you're going to potentially be buying that stock, and you don't want it dropping further. So you definitely don't want something that you think, hey, that'd be amazing if, it's going to drop significantly. I think the stock's going to drop significantly, and I want to own it, and maybe it'll come back up. You don't want that if it's going to be significant, but if there's going to be a tiny correction, that can be a stock you're looking for. So, things not to do, look for would be like, when we saw meme stocks over the last few years, or something that's really, really incredibly volatile. I would say you're looking for fundamentally sound stocks. And as I said, something that's in that pattern. You can identify maybe a pattern in the charts where it has a moderately upward trend to neutral trend in it.
Yeah, I mean, I guess to play devil's advocate here, those stocks, often they could be like value stocks, I think, in a lot of senses. Not necessarily, but they could be. They tend to be less volatile as well, and that means there's, generally speaking, going to be less premium available when you're trading income, and the wheel is an income strategy, right? So if somebody wanted to reach for some of those higher flying names, the ones that carry more implied volatility and the juicier premiums, what would they want to keep in mind as they're trading the wheel, again, to kind of limit their risk?
Well, that's a good point. Yeah, because I shouldn't even, saying exactly what I always think too, Rob, is, I would look at an option chain, and I wouldn't want to, that term, I think Huron uses this term all the time, where you're picking up pennies in front of a steamroller. I think you might have used that at one time too in inside investing. And so you don't want to go for those tiny, tiny premiums because it may not be worth your while on a stock that you possibly may want to own long term if it's a dividend stock or something like that. But the wheel strategy may not lend itself well to that. So I would say you can, when you said high flying tech stocks, you can look at more established companies that have decent growth. So we're not saying shy away from something that's going to have any growth. You would want to consider, okay, maybe I can go further out of the money. I can go to a lower probability that I'm going to get assigned. So if my example earlier, if I had a $100 stock, instead of selling a put at, $80 or 95 or something like that, where I could potentially have a chance of getting assigned because it does move a little bit, I could sell a put with a premium of $75 as an example. I'd be quite lower than what the actual current market price is at. There may be a little bit smaller premiums, but relatively speaking, you could get, say, $1 or $2 or $3. And you're fine with that if you could do that on a biweekly basis or a monthly basis. Collect a couple $100s. We always joke around, collect $200 and pass go. If you can do that every few weeks, that makes sense. And that's often what you're going to find on those stocks. Like, for considering things like, to mention, food stocks that just to give you an idea of what I mean, not a recommendation or anything like that, but things like Apple or Amazon or Nvidia and so on. Those are stocks that do move quite a bit in many cases. But if you're using the wheel strategy with those, you could kind of go further out of the money and know that it's going to stay within a certain range. Or not necessarily know for sure, but anticipate that it's going to stay within a certain range, and you can collect small premiums, versus collecting really tiny premiums on stocks that don't move at all.
I like the Monopoly nod there, Brian. Collecting or passing go and collecting $200 was always my favorite part of the game. I didn't really make money in that game any other way, so that was kind of my lifeline there. But in any case, speaking of like strike prices that you touched on there, making things maybe a little bit wider, so you can kind of offset the added volatility. A couple of weeks ago, we spoke with Kirk Duplessis from Option Alpha, and he actually said when he's trading strategies, he often likes to use ETFs rather than individual stocks. Let's hear what he had to say.
Okay.
I mean, I'm a fan personally of ETFs. So I think trading ETFs makes it a lot easier. What we've even seen in just the last, couple months and the last couple of years is that it's no longer this market environment where all the news for that stock security happens when they announce earnings, right? News is constantly evolving, and a single tweet from a person or a group of people can change individual companies. It's much harder for the market to move, or a tweet or some news event to move an ETF in a meaningful way.
Okay, so pretty sound logic there as far as I can tell here, Brian. What do you think about trading ETFs with the wheel?
Yeah, I think that's a good point. What he's saying there is that, ETFs, they do have that diversification. And there are a lot of ETFs out there that you can find, move enough with the market that even with that diversification that you can get, adequate premiums. Personally, it's not something I do. I don't really like the ETFs as much. I think it is something that's feasible. And I like what Kirk was saying. But, I kind of think of it as if you have a stock that or a few stocks that when well, and you've thought to yourself so many times, like, I kind of wish I had bought that stock, or I want to buy that stock. You can collect that income, like I mentioned earlier, get that discount to buy the stock possibly at a lower strike if it does drop. But otherwise, you can continue to collect that income on a continuous basis. And, how many times do we know, Rob, the market can go a little bit wonky, and, even with stocks that we really know it could drop significantly on us. We do find that over time, over the long period of time, if we end up owning that stock, there's a pretty good chance that it's going to recover and come back. So, there is that risk. There definitely is that risk where if you're selling puts on an individual stock, they tend to be or can be a little bit more volatile. But I think you want to make sure there is that caveat. If it's something you really know and something that long term, because there's really, really sound fundamentals, and that stock, the behavior of that stock, then I think using the individual stocks is my preference.
Okay, so since we're on the thread of, we've been talking about strike prices a little bit here, let's kind of continue that thread here. Are there any best practices that someone should keep in mind when they're trading the wheel when it comes to choosing the strike prices when it comes to the calls and puts that they're selling?
Yeah, one of the things I use, and this might be a new term that's coming out for everyone that's in the audience, and maybe those that are in that intermediate to advanced level probably have heard of this before, but you can use delta. Delta is a Greek that you can utilize, which oftentimes delta will indicate, the probability of that stock going in the money. So if you had a delta of 30, for example, there's a 30% probability, all else being equal, that stock or that strike that you're selling could go in the money and you could get assigned. That's one way to think of it. That's pretty low, right? When you're thinking 30%, it's not a huge probability. Some people might be scared of that and think, oh, I'd rather have like a 5% delta if I wouldn't want to get assigned ever. And that's okay too, because remember, but as you said, there's always that trade-off, Rob. You're going to get a lot less premium in that case. So I like, as a rule of thumb, I like to go around a 30% delta. There's another measure in a lot of platforms that would be like a probability out of the money. All that typically is, in most cases, is the inverse of that delta. So you'd be looking at about a 70% chance that it's going to stay out of the money. So you're going to be thinking, okay, there's about a 70% chance that I'm going to sell this premium. It might be just a few dollars, $2, $3, depending on the stock itself. Could be 3 or 4, whatever. There might be some juicier premium sometimes. And if I can sell that, and there's right now, all else being equal in the markets, is that there's about a 70% chance I'm going to keep that premium, I'm pretty happy with that. And then, then if it is a situation where it does get assigned, then that's where we move on to that second stage of the wheel, where we're going to sell covered calls when we own the stock. And then that's on that end, I typically do the exact same thing. Keep it simple. I do where I'm looking at options on the call side, usually always higher, the strike is always going to be higher. You're looking for, I might go a little bit more risk averse, where I might do, say, a 40 delta and a 60% probability out of the money, because I'm collecting income, and then I'm hoping I don't necessarily get assigned. But if I do, I'm getting assigned at a bit of a profit.
Okay, that's a nice little rule of thumb for people to keep in mind. And I will say, as a relative options novice myself, delta is the least scary of the options Greeks that I've come across. I think it's fairly intuitive to understand, and the way that you just described it as like the probability of success type kind of thing, I think makes a lot of intuitive sense. So thanks for that. Let's talk expiration dates now. When you're looking to sell these calls and puts for the wheel strategy here, anything to keep in mind when you're choosing an expiration?
Yeah, expiration, it's one of those things that, when we teach all of our options classes, we say to people, it depends on what you think is going to happen. With the real strategy, typically, like you're in a situation where you're not going to sell a put that's like 6 months from now, right? You could get amazing premiums, and maybe you want to buy that stock. And some people probably do that, I would say. Like, they're saying, hey, I wouldn't mind buying the stock even if it dropped down to such and such price. And if I do a 6-month time frame, I'm going to get a really great premium. I don't think that lends itself great to the wheel, but that could be something people do with selling puts. My personal opinion is in around that 30-day or less range. I usually look at 30 days, and if I like the premiums, I may do that, where I'm looking at, remember, that 70% probability out of the money. Do that both for the puts and the calls. But, in conversations with Marcus before the session, he actually has some really great examples, and ones where he does it a lot closer. He might do a week or 2 weeks at a time. But remember, that's also, too, you're going a little bit tighter in terms of your strike prices and things like that, because you're thinking, hey, I've only got a week. I want to get a little bit of premium. I might have to go closer to the money and be a little bit riskier and kind of living on the edge. But then if I buy the stock, then I can sell a covered call, and I might get assigned a week from now. So you're getting extra premiums from doing it a really short time frame by doing it close to the money. Or you can get extra premium. The other way I do it is if I'm doing 30 days, I can get a little bit of a longer time frame, and I might get more premium because there's more time value built in there. Might get a little bit more premium, but I'm just doing it on a longer time basis, where there's more time for something to happen one way or the other, but that extra premium works out for me where it's not super long term, it's kind of medium to short term, but it's just depending on what you think is going to happen in that time frame.
Okay, so these are some good rules of thumb for people to consider here. And ultimately, right, if you're not going to be too beaten up if you have to own the stock or let go of the stock in the case of assignment, it's okay. You can feel better about it, right? So whereas if you're trading stocks that you don't really want to own, then things get a little bit dicier, right? And the risk is heightened, I guess, in a lot of senses. So anyway, thanks for sharing those best practices with us here. Before we continue, I just have a quick question for our viewers. Are you enjoying the show so far? If you are, then make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook to get a sneak peek at upcoming episodes and a ton of other content designed to help you build your investing knowledge. We got tons of content on there. Make sure to check it out. And speaking of social media, if you're interested in options, then you might also want to check out this little promotion we have going on.
The TD Direct Investing Starter Kit contest is officially live. Canadians can enter today for a chance to win one of 5 prizes with a grand prize that includes an iPhone 16, a check for $100, 5 educational books on options trading, and a 1-hour private Q&A educational session with a TD Direct Investing Educational Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated June 2nd, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the contest post dated June 2nd, 2025. There's a limit of 1 entry per social media platform. The contest runs until June 30th, 2025. Scan the QR code for full contest rules and details.
Great contest. I know all of you out there want that iPhone, so make sure you check out the contest before time is up here. All right, Bryan, thanks for kind of taking us through how to set up the wheel and set up the trade. Let's talk how to manage it. And honestly, I find like the easiest way, again, is to just talk through an example here. So can you walk us through an example of a profitable wheel trade and sort of the rationale behind each step here?
Yeah, absolutely. So on a profitable trade, and once again, this is one of those things I keep mentioning where, you could have a number of different scenarios that could be profitable, but commonly what will happen is, you sell a put, maybe you sell it once, you may sell it twice. Let's say if it was for $100 as an example. Well, we've got this example up here. This actually was a trade that Marcus was going to run through, and one that he'd actually done himself. So if you can see on there, you see on the May 20th time frame, here's a great example where you sold an 83.5 put on May 23rd with an expiry expiry of May 23rd, sorry, and a 65-cent premium. That's not a lot of premium, right? But it's on 6 contracts that he did it on, and it was $389 collected in his account. So that's even more than $200. You pass go and collect $389, right? So if you can see, if you follow along and you go to that next green line, that green vertical line, that's May 23rd. May 23rd, then we're looking at, we got assigned on the stock, and we had to buy it. This is where I talked about earlier that it's really important to have that cash. There's $50,109 that went out because this was an $83 strike price. So the stock was trading, around 80, I think $81 or $82, at that point. It dropped down. So now he's going to buy the stock. So you're sitting there with 600 shares of stock. And what this trade did is, bided your time a little bit and waited. Okay, the stock jumped up slightly. It got up to around that 83.5. In this example, we're using the same strike every time. You may not do that with the wheel strategy. You don't have to do that. You could do, higher levels if you wanted to, if you're selling a call. But the premiums are going to be fairly high. And especially in that middle, if you see on that June 3rd to June 5th time frame, there was a trend, a little bit of a trend showing that there might be a dip in the stock in the short term. So what happened was if you see down on that bubble down on the bottom near the June 13th, this trade sold covered calls, 6 contracts, again, because you have 600 shares of the 83.50 strike at 75 cents. So notice here, like these premiums aren't super high. They're 65 and 75 cents. And so that was $449 collected. So that's another chunk of money that you're chinging the cash register. You're having more money coming in, and you still own the stock at this time, right? You still own the 600 shares of stock. You can see what happened right after that. This is a really great scenario from a profitability perspective, is that when the stock dipped a little bit after that, the stock dipped slightly, the options will reduce in price. So instead of being at 75 cents anymore, because there's a little bit of time that went by, a few days that went by, and volatility dropped slightly and the stock dropped slightly, so the options are getting out of the money, we were able to buy them back at 7 cents a contract. So $42 went out of the account, but you collected $449, right? And these ones actually include commissions and everything as well. But then next thing you know, you still own the stock. You still own 600 shares of this particular stock, and or this one was an ETF, actually, the XLE. And then you notice that on the last line there, the second last line under the June 9th, you can see that we sold some more covered calls. We sold 6 contracts at 85 cents, so collected another $509. And the strike price was the same. It was $83.50. Then you can see as that stock went up, it went up. It's not a significant amount. It looks like a lot because this is a chart that's not a huge range. It went up to around about $88, so it went up about $5. So we lost out. There's that opportunity cost on that. We lost out on the shares a little bit there, but we ended up selling our shares at $50,090, and then that was the end of the trade. So one key point to make here, if you want to highlight a visual, is the fact that the most we paid for the stock was $50,109 for those 600, or the ETF, for those 600 shares of that ETF. We sold it for $50,090, so it was actually somewhat of a loss on the stock itself, $100. But we collected 400 on the first day. We collected another 450 a few days later, and we collected another $500 a few days after that. So what's that? Almost around, I'd say about $1,400 or so, Rob, within about 2 weeks on a stock that was basically break even.
Yeah, I mean, that's pretty cool. I mean, I think, you have to be comfortable with having $50,000 going in and out of your account in this example, right? But provided that you are, the income stream that you can get here, if things go well, can be pretty attractive. One thing I think to keep in mind, though, is a lot of options traders, they don't want to take their contracts to expiration. They often like to close them out a little bit earlier. I'm wondering if you have any best practices around, knowing when to take profit or even cut your losses when you're trading the wheel.
Yeah, there's going to be all kinds of different answers for this, for depending on who you're talking to. But you often see a very similar thing with guys that are on insider investing in options education month and so on, is that they're looking for a certain amount that they want to get out and eliminate that obligation. So in our example, where we had the earlier example where we collected 75 cents, or I think one was 65 cents initially, and Marcus agreed with this too. He agreed exactly with what I would have thought, is you want to have a plan in mind to say, well, let's say if several days go by and the stock does what I thought it was going to do, it didn't move a lot, it stayed fairly neutral, maybe it went up a tiny bit, which would be the ideal thing if it does go up slightly. Now you can get out and just to eliminate that obligation of having to buy the stock in case it drops one day, you wake up the next morning and it's dropped significantly. Usually we say if you have at least about 90%, or if you have about 90% of your profit that you can keep, get out of that option and then do it again. And you're going to free up some capital to be able to do it again, because there's a margin requirement, or if you're using like what we call a cash covered put, in a way where you're making sure you have that $50,000 that you mentioned earlier, Rob, then that gets freed up and you can do it again. So main point being, just to give you an example, if we had the 65 cents that we collected, what could happen is those options, due to time and time decay and a little bit of volatility, and it's getting close to expiration. Let's say if it's trading at 15 cents, I might just go ahead and buy it back and close that option and keep my 50, what would that be? 50 cents, right? And you can do the same thing with the calls as well. So if you sell a call, in our example, we sold them for 85 cents. If it was getting, in that example, the stock went way above our strike price, but if it didn't, and time decays options, especially if price doesn't change, then I could buy it back. I'd buy it back maybe at 70 cents as an example, 70, 75 cents. So usually looking at, if you have a chance to keep 90% of your profit and it shows up, doesn't matter what day it is, just take it. Take it, buy it back, close that position, and do it again.
Yeah, it might not be worth like the risk reward to try to squeeze out like a little bit extra more value there by holding it to expiration. That totally makes sense. Thanks for filling us in on that, Bryan, here. And of course, all those best practices that you shared with us were fantastic. And I want to find out, though, how to put this all into practice now. So TD Direct Investing's other senior client education instructor, Caitlin Cormier, is here, and she's going to show us how all of this is done in TD Active Trader. Caitlin, are you on the line with us?
Yeah, absolutely. So great to see you. And as well, Bryan, good to see Bryan taking the lead on today's session. I love the wheel strategy. So excited to show you how to put it in action in Active Trader.
Awesome. Yeah. Welcome back to the show. Always lovely to have you here. So without further ado, show us how could you trade the wheel strategy in Active Trader?
Yeah, the great thing about this particular strategy, Bryan alluded to it a little bit earlier, but the actual kind of strategy, putting it into action, is pretty straightforward. They're only single leg trades. You're selling a put, you're selling a call, and that's really the whole trade. So it is pretty straightforward. That being said, let's hop into Advanced Dashboard and see what that actually looks like. So kind of talking about the ETF side of things, I have brought up an ETF to go through this example today. And then talking to Bryan, he kind of said somewhere within that 30-day range is what he's looking for an expiry date. So if I kind of look through my option chain, I can see the days to expiry. Let's go ahead and choose July 18th, so 22 days, so kind of somewhere in the middle. And so we're going to look on the right-hand side because, of course, the first thing we're going to do is sell a put. So we're looking at the right-hand side of the option chain. And Bryan had mentioned either kind of a 30 delta or about a 70% probability out of the money, which I've added to my option chain here so I can see both of those. So this particular price that we see is actually pretty close to the current market price, but it is at that 30 delta and the 70% probability out of the money. So if we're following those rules, we could go ahead and sell this particular option. You'll notice if I hover over the bid price, it's going to even pop up and say this is how you sell it. So I can go ahead and click there. You will notice that it's a 15 cents per share premium. So of course we multiply that by 100 to get the total amount that we would receive. As long as we're good with everything we have here as far as limit price, and we're sure that we're doing a sell to open, we can click confirm and send. It will show us what our max profit as well as our max loss on this particular trade would be, which would be if we have to buy the stock for that $26 price and then the stock were to go to zero, that would be kind of our max loss in this scenario. So as long as we're good with all of that, we're going to go ahead and send the practice trade. Once we've done that, if we go to our activity and positions, we're going to be able to see the fact that our new position is right here. So we can see that's in our, in our holdings. If we wanted to close it, we just simply right click, closing order, close with limit order, and we can go ahead and send that through. So if things have changed and we want to get out of the position, it's very simple and easy to do that. And then of course, if we wanted to, if we do get exercised, we own the shares and then we want to sell a call. It's a similar sort of idea. We're just looking at the opposite side of the option chain. So the left-hand side is where we see calls. And again, depending on what our parameters are, if we were still looking at around those same sort of percentages here, then we might want to go, I don't know, maybe a little bit, maybe up to the 27, and we could potentially sell the 27. And it has a 20 delta and an 82 percent probability out of the money. So then again, same idea, we would just click to sell, make sure that it is a covered call so that we would own the shares, so it'd be covered. And again, we just send it through and that would be a little smaller premium because we're seeing 5 cents per share. But essentially that's how you can kind of roll through those trades.
Okay, fantastic walkthrough. Very easy to follow here, Caitlin. Appreciate that. One thing I just wanted to ask before we're out of time here, we're almost at the end of Options Education Month, obviously. Are there any workshops still on tap that you feel could help traders trade options for income, be it the wheel or otherwise?
Yeah, absolutely. Let me show you within. So if you go to www.td.com/OEM, you'll be able to see that we have our our website here. You can go into see more about our workshops. And if you go into the first one, which is understanding the fundamentals, it's this one here, you'll notice we have something called generating income using the covered call strategy on Monday, which is going to be income, of course. And then tomorrow morning at 11 a.m., we have rolling in premium, mastering the wheel strategy with Jason. Of course, another excellent class to check out.
Awesome. Thanks for flagging those for us. And thanks again for joining the show, Caitlin. That was Caitlin Cormier, Senior Client Education Instructor here at TD Direct Investing. Okay, back to you, Bryan. We're going to have to leave the interview portion of our conversation there, but we're not done yet. We're going to open the floor and take questions from our viewers here. So, Bryan, are you ready to know what our audience wants to know more about?
Yes, yeah, let's do it.
All right, let's get to it here. Let's get our first question up on screen here. We have a question coming from Eric, and Eric wants to know, how do you determine if a premium is juicy over what is normal?
That's an awesome question. I love it, and they use the terms that we like to use too, Ralph. I love it.
Yeah.
So we're talking juicy in the sense that, like something that you feel is an adequate premium to receive, for the risk that you're taking as well. One of the things you can look at, and we have that in Advanced Dashboard too, or one of our platforms, but you can find it pretty much anywhere, is you want to look at, there's an historical volatility. And what that is, if you think of historical volatility, think of a chart. Remember, a chart is history, right? A chart is showing all the different points that the stock has traded at over a period of time. And usually they give you like a 20-day rolling average historical volatility. Let's say if the number was, 50. And that happened to be what the case is for that particular stock. And oftentimes, as you're familiar with that one stock, where it often is sitting, you can look at another measure that's called implied volatility, and that's what the market is expecting. So it's the unknown. Oftentimes, implied volatility is really high just before earnings for a stock, or let's say if there's a FDA announcement for a healthcare stock or some kind of news expected related to the stock or some type of event. So you can use that historical and implied volatility. And what you want to look for is you don't want to have anything that's really a huge anomaly, in the sense if implied volatility was like 500 and historical was like 40 or 50, like I mentioned, that'd be something a little scary. That's a huge volatility, and you're going to be in potential trouble if you sell a put and you get assigned and the stock goes way down, as an example. So you want to look for something that's slightly higher if you're looking for juicy premiums. Like maybe it would be 80 or 90 as an example. And one of those things we didn't get a chance to talk about is you may want to avoid doing the wheel strategy just before earnings for a stock, especially if you're doing something that's, we mentioned earlier, like a tech stock or a really popular, highly traded stock, because that volatility can be high, and that means there's an expected move potentially in the market. If you do decide to ever do that, make sure you're looking at really far out of the money strikes for either both the puts or the calls. But I would say, to answer the question on the juicy end, is that, yeah, if you're looking for a slightly higher implied volatility, and then you can say, okay, that looks like a pretty good premium that I would want, and then that would make it juicy in my mind.
Mm-hmm. Okay, yeah, I'm salivating already. Sounds tasty. Let's get to our next question here. This one's from Marcella. Marcella wants to know, could you please talk about the risks of the wheel strategy?
Yeah, this is something we always want to touch on because there is a big risk. And that's why we can only do that in the margin account with that level 4. And the big risk being is, remember I mentioned, you can kind of mitigate the risks in a way, and you can try and know the stock as much as possible. But we all know that something could happen in the market, something could happen in the news, and that stock could drop. Even individually, there's the individual risk of that stock. If there's something, maybe their CEO got fired or something like that, and something could happen where that stock could drop significantly. So on the put, remember when you're selling that put, you are obligated to buy that stock. Even if it went down to 5 cents, you're obligated to buy it at that higher strike that you sold it at. So if you sold a $50 strike and the stock was trading at $60 and it went down to 5, you're going to have to be forced, like let's say if that happened overnight, you could potentially be assigned, that's the term we use, assigned, where somebody at the other end has said, hey, I'm forcing you now to buy the stock at $60 when it's trading at 5. That would be a significant loss, right? You could hopefully potentially recover, if it wasn't as extreme. Let's say if it only dropped a little bit below your strike and you hold the stock and maybe the stock will recover. And one thing, even my colleague here and I had talked about that, he had that happen to him. And if the stock drops significantly, you can own that stock and sell calls for a significant amount of time, and hopefully it comes back up, to your cost. That would be great, but that's a massive risk. And then the other risk on the covered calls, we always talk about the covered call strategy when we do classes on that. A lot of people say, oh, it's like a no risk strategy. I don't even have any risk. Remember, when you own the stock and you sell a covered call, there's still the downside risk. The stock could drop. But on the upside, yes, you could sell calls at a strike where you're going to have a profit if you get assigned. But what if the stock goes to the moon, right, and goes, 50% higher than what it's at? You have that opportunity cost, which is a risk in itself. So be careful on that, where you might be, I've done it several times, you might be kicking yourself and thinking, hey, I sold a strike that was a little bit higher, but then let's say if I sold on a $100 stock and I sold a $120 call, if I get assigned, I'm going to sell it at 120. But I've had the stock go to 180 in that short period of time, which is my fault on doing it on a volatile stock. But I was kicking myself thinking, hey, if I hadn't have done that, I could have sold this stock for $180 a share.
Mm-hmm. Yeah, with all these options trading strategies that are for income, right? You have to give up something in order to get something. You get income today, but you have to risk something, upside in the case of the calls there. I think we have time for one more question here. This one's coming from Satpal. Satpal wants to know, do you use weekly or monthly options? Bryan, I believe you touched on this a little bit earlier, but maybe you could just kind of underscore it for us.
Yeah, I would say, to me, on most stocks, it doesn't really make a difference, in my opinion. The weekly or monthly, because you're going to notice in active trader, when Caitlin was showing that, there's just that time to expiration. Depending on the time, like if you happen to be looking at it in the middle of the week, sometimes you could use weeklies if you find something there that's like, hey, if I only have 3 days till expiration, maybe I can get a chance to get a decent amount of income and potentially buy the stock if it does dip below, depending on what strike you're using. So in those situations, I may use weeklies, do like a 2-week time frame. But I also like to use monthlies as well in a situation where I'm like, oh, okay, this is a pretty good premium because I'm getting a bit more time. But in my opinion, it doesn't matter to me. It doesn't matter. I don't look whether it's weekly, because sometimes you can see options will be designated as weekly, monthly, or quarterly. So that's what the person was asking there. And some stocks don't really even have weeklies, which I probably wouldn't recommend doing the wheel on that, because that's usually stocks that aren't very, have a high ton of volume or open interest. But really, I don't ever see any difference between the weeklies and the monthlies.
Okay, there you go. So a little bit more breathing room or options, I guess, for you to consider when you're trading the strategies. Bryan, thanks so much for taking those questions. Thanks for showing us how to get the wheel rolling here. We appreciate you joining us on the show here and jumping in on short notice here. So thanks again. Really appreciate you having on your show.
No, my pleasure. Thanks so much, Rob.
And for you in the audience, thanks for tuning in. Of course, Options Education Month is just about over, but we still have plenty more inside investing episodes coming your way. Next week, we're going to be discussing some of the top investing lessons from legendary investor Peter Lynch. A veteran portfolio manager is going to share his takeaways from the investing great and how it helped him make his clients money over the years. That's all the time we have for now, though. From everyone at Inside Investing, thanks again for watching, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.